Good morning, friends. This is CA Sangam Aggarwal, and I welcome you all in this session. Firstly, fam, I express my sincere welcome to all because today on Sunday at morning 11:30, you all are here to know about the consolidation financial statement. So this is my warm welcome to all of you because this is the one of the very unique session we are going to have today. Just a minute, friend. Anil is just going to join us. Yeah. So, friend, today's we have a topic of consolidation of financial statement. So, friend, in this session, we will cover three Ind AS basically. First Ind AS is Ind AS 110, that is consolidation of financial statement, joint agreements, joint arrangements Ind AS 111, and investment in associates Ind AS 28. So friends, as you know that Ind AS is one of the latest thing requirement in making financial statements, and consolidation is one of the things which is really very important because nowadays Ind AS is applicable mainly on the all large companies, and on large company somehow subsidiary are there and they require to consolidate their financial statement. So today's session is going to be one of the very unique session and important session. So I request my all the participants kindly be connect with us during today's session, and you can ask your query in comment section. We will take your all queries in last session, which will be our Q&A session. And friends, we will also let you know that whatever PPT we will use in today's session, the link to download such PPT will be given in the comment section. You can download post session PPT from there. And friend, now I request you kindly subscribe our channel and click on the bell icon so that you can get the information of upcoming sessions. We have more than 50 sessions on our YouTube channel on different topics, so you can watch such topics also. And now I'm going to brief profile of CA Anil sir. CA Anil ji having 14-year work experience, and he is worked with the Ernst and Young, that is EY, and currently working with the independent consultant working on Ind AS, IFRS and training projects. He is currently working as an independent consultant providing consultancy to many companies. So it is proud privilege for us to add he is with us to discuss on another topic because he has already taken one session with you with us. So he will take another session today with us. Now I will not take your much time and invite Anilji to take this session forward. Over to you, Anilji.
Thanks, Sangam, for the briefing part. Good morning and welcome all on this webinar on this consolidation of financial statements. So the agenda of the today's session would be to discuss about the overview of this consolidation of the financial statements. So before that, let me share the screen as well. So the agenda of the today's session would be to discuss about this overview of this consolidated financial statement. So basically, we will discuss three standards, three Ind AS. One is relating to the Ind AS 1110, which is the consolidated financial statements. Second, Ind AS, we will discuss about this joint arrangements, which will be covered under this Ind AS 1111. And the third topic would be accounting for associates, which is governed by this Ind AS 28. So these three topics, three standards we will discuss under the consolidation part, because all the three standards are part of the consolidation accounting. In next 1.5 hour, we will discuss these three standards, and at the end of the session, we will take the Q&A, question and answers, right? So let's start the discussions relating to the consolidation of the financial statements. So first standard is Ind AS 1110 consolidated financial statements, right? So if we talk about this consolidation, right, in the simple layman language, it would be just to consolidate or just to add the numbers of your subsidiaries, right? So A plus B is equal to C. This is the consolidation.
Anilji, sorry to disturb you. Can you make
Yeah.
it a presentation mode? Because it can become
Yeah.
larger. Yeah.
Yeah.
Yes. That's
Yeah,
fine.
so we were discussing about the consolidation under the common layman language. So in common layman language, consolidation means if we want to add the number of a subsidiary or a joint venture into the parent's account, it's called the consolidation, right? But what are the definition? What are the measurement that we need to, or what are the rules and principles we need to follow under the consolidation rule? So we will discuss about all the things in this session. So every and each and every standard is having their own objective and their scope, right? So in this Ind AS 1110 consolidation of financial statements, the objective of this standard is to how to set the principles for the preparation and the presentation of the consolidated financial statements by defining the control rules. So right, so this standard has set the rules how to define the control. So 80% of the discussion would be to define the control. If you read out the standard 1110, so 80 or 90% of the discussion is related to the control definition only, right? So that's why this is a very important one to understand the objective and the principles of the consolidation of financial statements. The second objective of this standard is to set out the accounting requirements and the presentation of the consolidated financial statements. Third one is the investment entity, which is a very important one because that was not there in the IGAP accounting. So investment entity is a very new thing. So this standard has set out a rules. What is the definition of the investment entity and whether they will be excluded or included under this Ind AS 1110 consolidation part. Because this investment entity, the standard says that you need to measure all the subsidiaries at the fair value through profit and loss account under the Ind AS 109 requirements. So they have been excluded. So detailed discussion has been given under this investment entity accounting. So we will discuss this investment entity accounting in the later slides. So three objective basically we will discuss under this Ind AS 1110 part. Second thing is the scope. What are the inclusion and exclusion? So whenever the objective has been set out, so there is a scope will also be set out. So what items or what things that will be covered under this 1110 part, or what items will be excluded while preparing the consolidation part. So this standard will not be applicable, or we can say that a parent need not present the consolidated financial statement if it meet all the following conditions. Means if it is a wholly owned subsidiary. So please keep in mind the two things in this session. One is a parent company, another is a subsidiary company, right? So parent means who is having an investment into the another company. So another company will be called as a subsidiary. So parent and subsidiary relationship should be there. So if it is a wholly owned subsidiary or a partially owned subsidiary whose owners have been informed and they have not objected for not preparing a consolidated financial statements, right? So this is the one of the thing that in this case, we don't need to prepare this CFS. Second thing is if my debt or equity instruments are not traded in the public market, right? Or they are not in the process to file into the public market. So in that case, also this consolidation is not required. The third thing is that it's if the ultimate or any intermediate parent company produces these consolidated financial statements and they are available for public use and comply with the Ind AS, right? So that means the other companies are not required to prepare these consolidated financial statements. This standard is also not applicable for these employment benefit plans, right? Under which this Ind AS 19 employee benefits are applicable. So that means this is also been excluded from the consolidation of the financial statements preview. The third, the last thing is which has been excluded under this consolidated financial statement is the investment entity. So which I have already discussed under this objective part, right? So investment entity has been excluded. If my entity is falls under the investment entity definition. So what is the definition? We will discuss later on. So my entity will be out of purview from this consolidation financial statements. That means under the 1110 Ind AS principles. So under this Ind AS 1110, the investment entity will be excluded. That will not be applicable. So I will measure those investments under the fair value through profit and loss model, which has been defined under this 109 part. But but when we talk about this inclusion and exclusion, in the Companies Act as well. So the definition has been defined. What is the meaning of the subsidiary? So we will discuss this in the later slides, right? So that was all about the objective and the scope part of this Ind AS 1110. So now let's compare with the current accounting. Current accounting means with the IGAP, right? So what are the basically overview difference, right? So higher level difference between this Ind AS 1110 versus AS 21, which is the IGAP accounting. So in simple terms, if I want to say that if I am having more than 51%, more than 50% shareholding in the another company, right? So I will become a parent and the another company will become a subsidiary. So that means I will apply this consolidation rules. So that is the all about under this AS21, which is called the IGAP accounting. But under this Ind AS, it is not necessary that only the shareholding pattern you need to keep in mind. There are the other factors as well against which the discussions will be required, whether the consolidation will be applied or not. So that's why this Ind AS 1110 has set out its own rules. What are those rules? We will discuss it, right? So that's why this is the difference between this currently IGAP accounting versus this Ind AS 1110. So control under this Ind AS has been defined by power plus exposure to variable returns plus use of those powers on those on which will affect my returns, right? So each and every definition we will discuss in this session. So that is the primarily difference between this IGAP and the Ind AS. The second thing, the second higher level difference or overview is that if suppose I am buying a company on which will going to be sale on in the near future, means I am buying a temporary company which I will sell in the near future, right? So AS21 says that you don't need to require to consolidate, but Ind AS doesn't give any such type of exemption. If you buying a company on temporary basis, then again you need to consolidate that subsidiary as well. So that is the difference between this AS21 and Ind AS 1110. The definition part under this AS21 is more relating to the objective part, right? So definition or the facts has been given under the legal part, we need to follow. But under this Ind AS 1110, we need to follow the substance over form rather than the legal formalities, because substance over form will govern whether the entity we will need to consolidate or not, right? So let's take an example. Suppose you are having a holding of 48%, right? But we are meeting this control definition. What is the control definition? We will discuss it. This is the constituents of three things. So now the question is, under this I gap, we don't need to consolidate it because my holding is less than 51%. But under this Ind AS, yes, if control definition is there and we need to see other factors as well, might be that this 48% holding 48% company which against which I am having this shareholding, I need to consolidate it, right? So this is a substance or form and other facts we need to consider. We will discuss this in the later slide. So that was the overview between this Ind AS and the IGAP part as far as the consolidation of financial statements are concerned. So now we are discussing about this consolidation. So consolidation means parent plus subsidiaries accounts, right? So can we say that parents are having the subsidiary? Subsidiary could be your Indian subsidiary, subsidiary could be your foreign subsidiary, right? But the control part should be there. This is called the group. What is meaning of the group? Group means parents are having the investments in the subsidiaries. Subsidiary could be Indian company or subsidiary could be your foreign company. So we need to consolidate it. So it is called it is basically the group structure. I am I have presented in this slide format. So when we talk about the Companies Act, so now let's discuss the definition which has been given under this Companies Act, right? So company means which has been given, the definition has been given under this Companies Act. So this subsidiary definition is very important, because as and when the subsidiary definition we uh, will be part of this consolidation. So that's why this definition is very important to understand. What is the meaning of the definition? The Companies Act says that the subsidiary includes associates as well as the joint venture, right? So it doesn't mean that you are holding any or you are having any subsidiary. Might be that you are having any associate or joint venture. Associates means, in simple terms, we can say that more than 20% holding. It means the significant influence is there. So So now suppose you don't have the subsidiary, means you don't have any company in which you are having a more than 51% shareholding, but you are having a company wherein the associate principal relationship exists, means more than 20% holding you are having in another company. So that will become your associates. So Companies Act says that the subsidiary includes associates. So that means as and when the associates or joint venture would be there, I need to apply the consolidation accounting, as simple as that. So that means this India's parameter for the consolidation point of view is much broader than the IGAP accounting, because the Companies Act already says that the subsidiary includes your associate and joint venture. So might be that don't have any subsidiary, but you are having the associate. So in that case as well, you will apply the consolidation principles as per this Ind AS 1110, right? So now come to the discussion part relating to the control, because this 1110, India's 1110 is based on the control model, right? 80% of this the discussions is will be around the control definition only, right? How to apply the consolidation is very, very simple, because 5% of the discussion time has been given in the standard relating to how to apply the consolidation. But the discussion relating to the control part, 80 to 90% time has been spent on that part only. So now let's discuss about this control part. What is the meaning of the control? Because as and when I am having a control of your company, I will apply the consolidation. The standard doesn't say that I am having more than 51% holding. The standard says that the control, as and when I am having a control of your company, I will apply the consolidation. So that's why this is the difference between this IGAP versus Ind AS or IFRS. So now let's discuss about this control definition. Control constituents of three parts basically, right? The first thing is that power over the investee. So we will discuss about what is the meaning of the power, right? Power over the investee. This is the first thing. Second thing of the control is exposure or rights to variable returns from its involvement with the investee. How much exposure or how much returns I am getting by making an investment in your company. Higher the returns, higher will be the power, higher will be the magnitude, right? So this is the second thing that that the definition has been defined under this control part. The third thing is that I am having the power, I am having the exposure. I should have the ability to use its power over the investee to affect its returns. Means I should have the ability to affect those returns as well. Unless and until I am having the ability against which I am having the power, I can't say that I am establishing a control in your company. So that's why these three constituents, we need to see all these three constituents in a together form or in a simultaneously form, right? So three factors should present while making a discussions or while establishing a relationship under this control model. So now let's discuss this first part, which is the power over the investee. So when we are discussing about this power, so how a person can get a power? Power will be derived from the rights. Rights means it could be the voting rights, or it could be the other contractual rights. But this power should be derived from the rights. So these existing rights that give the current ability to direct the relevant activities. So we should understand what is meaning of the relevant activities in a corporate sector. That's why I will be in a position to show that I am having the right and having the ability to direct the relevant activities. So power arises from the rights. It could be the voting power rights, or it could be the contractual rights. Voting power means you are having a percentage of shareholding into the another company, wherein you can show that, okay, I can ask the other company to take a decisions at my level, right? At my discretion. That is called the rights. So these rights come from the voting rights, or it could be the contractual right. Contractual means that I have signed an agreement between these two companies. I can ask the other person to take a decisions at my discretion, right? So this is called the power rights. And the rights should be on the substantive forms. What is the meaning of the substantive? We will discuss it. Substantive means that uh, uh, the I have the ability to take the power in a more proactive way, right? There should be no any restrictions or no any obligations on the other's part. So power should be substantive rights, not only protective rights. Suppose in case of the multiple investors, two or three companies are having their investment in a single company. I am having 40%, another is having 40%, and the third one is having 20%. Now the question is, who is having the power? Because the consolidation will apply as and when the control would be there into the another company. So in that case, we need to see which investor is having a more substantive power as compared to the other investors. So right, so these type of the things we need to see by analyzing the part of the power over the investee, right? So under this power, we have mentioned that the relevant activities, right? Current ability to direct the relevant activities. What are those relevant activities against which I should have the ability to direct the company at by my discretion? It could be the capital expenditure decisions. It could be the acquisitions or disposal of the subsidiaries. It could be the preparation or the approval of the budgeting part, because it's a very, very crucial process as and when the budgets will be prepared, right? So how much percentage I have to allocate to particular activity, how much percentage I have to allocate to the another activity. These type of the decisions, because the investors can influence while preparing this budget or the operating budgets parts. Dividend, how much dividend I will declare. Remunerations part, how much remuneration I will give to the KMPs, key manager personals. Selling and buying goods, how to sell the price, how to fix the price of my selling activity, at what margin I should earn from the company level, right? So these type of the decisions, that these will be covered under the relevant activity part. Who is appointing the board of directors, right? Who are appointing the key managerial personals. So these are the activities wherein I can say that I can influence the other person. If suppose in this type of activity, I am having an influence in any of the part which is covered under the relevant activity part, I can say that, okay, I am having a control over the other company. But control should be from the voting rights or other contractual arrangement. If you are having a 10% investment, you can't say that I am having a full control over your company. Voting rights should be there, but voting rights means it could be 40%, it could be 50%, right? But under the presumption, under the consolidation part, we are presuming that we are having a investment more than 51%. But under this Ind AS, it is not necessary that 51% should be there. It could be 48%, it could be 45%, right? If and if even only if you are having an investment 51%, so I will presume that I am having all control in your company. I will by default make the consolidation by making this subsidiary plus parent company accounting, right? So this discussion will require only and only when you are having a shareholding nearby to 50%, right? But other factors we need to see. So this is called the relevant equity part. Now let's take an example of the relevant activity. Suppose there are the two investors who have invested in the investee called C, investor A and investor B. So company is into the pharmaceutical, right? So they are into the drug manufacturing company. So now the question is, if they have making an investment into the investee, now the question is, who is having the control? Control means who can take a unilateral decision, right? So suppose investor A is having a control over the regulatory part. Regulatory part means they are having a control over how to take the license from the drug authority, right? So how to obtain the approval from the government agencies. The second investor says that, okay, after this approval part, I am having authority to sell, to fix the price of the particular drug, how to sell that drug into the market, right? So post regulation part, the other thing are required are held by the investor B. Now the question is, who is having the control over the relevant activity? It could be, if this is the judgmental facts, right? So it depends upon company to company. So there is no any certain answer of this question. Who is having the control? So as per my point of view, I can say that, okay, regulatory part is more important. I am having a full control. But as in the second person or as an audience, you can say that no, investor B is more important because he will fix the price, he will earn the margin, he will fix all the markets from which market they need to sell. So it depends upon person to person, and it depends upon the judgment that you will make while doing this control analysis. Who is having a control, either A or B, right? So who is having a mostly influence onto the decision making part, right? So this type of activity or this type of the things we need to analyze while making this control model under the power part. So now, so as we discuss this control or the power come from the rights, right? So what are those rights, or what are the indicators that will indicate, okay, I am having a control over your company? It could be your voting right. So voting right could be very easy one, right? So voting could be from the shareholding, from the shares you will held in your company. So that is a very simple one, right? What are others factors that we need to keep in mind while applying? So it could be right to appoint or KMPs, right to resign the KMPs, or other shareholding decisions, right? So that can be the one part wherein you can say that okay, such rights will give you a power. Right to appoint or remove another activity that directs the relevant activity. Right to direct the investee to enter into or veto any changes. Suppose a particular thing has been decided by a group of investors, but I am having a veto rights. Veto rights means I can change those rights. Whatever the decisions that you have taken, I have a right to apply the veto power. So that means my power is more than you, right? So these things will give you a power over the company. So that means your control would be on the substantive one, right? So you are having a more control as compared to the other investors. So in indicators of the such rights would be, in case suppose a particular investor is dependent on you, it could be that you have provided a financial guarantee, right, against without which you can't run your company. You have provided technology to the another investors. It could be the another thing, because you have provided the funds. Without funds you can't say that my company will run, right? You have provided a KMP. Suppose I have provided a key manager person to your company and the KMP can't take a decision without my permission. So that means this is also indicator that okay, I am having a power over the another company. So 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 these are the activities and these are the things we need to keep in our mind while applying this control model. So voting is a very simple thing, because through this it will automatically be fall under the control definition if I am having more than 51%, right? So but apart from this, there are the certain things we need to keep in mind, like the guarantees, like the financial assistance I have given to the other company, right? I have given the technology, I have given uh, uh, the key managerial personnel to run the company. So that means my power is there into your company. So when we talk about this voting rights in terms of power, in terms of the voting rights, right? So voting rights means that you are having more than one half of the shareholding, means 50 more than 50% holding. So it means it will be called as a control model will get applied. The power, this 51% share should be on the substantive one, means I can apply on a proactive basis, right? So I can apply this judgment. My rights would not be on the proactive one. My rights should not be protective rights, it should be proactive one, and must give the holder the ability to direct the relevant activities mostly by financial and the operating ways. Means I should have the ability how to influence the decisions or how to influence the relevant activity at per my discretion level. So these type of the things which will give you a way that yes, you are having a control. Up now, suppose that apart from these voting rights, apart from these voting rights, from where you will get this power? It could be the contractual arrangements, right? Contractual arrangement means that you have signed a contract with the other investors, wherein it can be shown that okay, the particular person or particular company will be having a control or will be having a power over the another company. So it could be the contractual arrangement, or we can say that the rights come from the contractual arrangements. Voting rights, yes, we have already discussed. It could be the potential voting right. Potential means that the instruments in the form of convertible form, means preference shares which will be convertible into the equity, or the debentures or the bonds will be converted into the equity. Might be that you are having a 36% shareholding, but there are the certain financial instrument you have hold which is into the convertible form, which is called the potential voting rights. Means you will in the future you will get this instrument into the equity form. So that means this voting rights will also give you, this potential voting rights will also give you a power while making a analysis of this control model. Or we can define, or we can combine any of the factors just to analyze this our control part, right? So now take a situation where you are having a less than 50%, means 47%, 48%, 49%, or 45%. You are having a less than majority of the voting power. But you are having a practical ability to direct the relevant activities unilaterally. How we can define that I am going to take a decision on a unilateral basis, not on the unanimous basis, on the unilateral basis. Unilateral means at my discretion level, at my single individual level. I'm having a 45% shareholders or 45% holding in your company. So now let's take a situation wherein the majority is having less than 50% shareholding. We have to see the other facts. Means if suppose there are the 55% shareholding held by the other investors, but now we have to see this 55% shareholding is held by 2%, 3%, or widely spread basis. This shareholding is widely spread basis. Means if suppose this 55% holding is held by 1%, held by thousands of shareholders. So that means I can say that this 55% can't take decisions on the mutual basis. They need to consult all the 55% shareholders at a one time if they want to take a decisions at the company level. So now the question is, I am having a 45% shareholding, and the other investor, which is 55%, held by thousands and thousands of shareholders, right? Suppose 1,000 shareholders held by 1,000 shareholders is being there, who is holding 51%, 55% shareholding, and I am the only one who is holding 45% shareholding. Now the question is whether I'm in a position to apply this control. So this Ind AS 1110 is defining this type of the rules, wherein my holding is less than 50%. Still, I am in a position to influence the relevant activities decisions, right? So in this case as well, I can see that, okay, 45% is the majority shareholding, right? So I can take each and every type of decisions, but provided that I have to see whether this 55% shareholders, 55% holding, which is held by thousands of shareholders, they have any veto rights to change my decisions or not. So these type of the decisions we need to see whether I am having a control or I am having a power over your company or not. So the discussion of this slide is the topic of the slide is investors voting rights, right? So voting right means less than 50%, but still I'm in a position to influence your relevant activities or influence your power, right? So there is no any single thing which we can say that we need to apply this more than whether having a control in your company or not. Now let's take an example of this point wherein I am having 48% holding. So suppose investor A holds 48% of the voting rights of an investee B. The remaining voting rights are held by thousands of other shareholders. None of the individually holding more than 1% of the voting rights. None of the shareholders has any arrangement to consult with any other shareholders or make collective decisions. So relevant activities are directed by simple majority. 48% shareholding, as example I have already discussed. So now whether I can say that I will be in a position to influence the activity, influence the decisions which will be taken by at the corporate level. So in this case, we can say that I am having the control of your company because none of the other shareholders are in a position to consult with the other shareholders who can take a decisions on the mutual basis. So we can say that I am having a control over your company. So that's why this is not necessary that only 50% shareholding pattern or more than 50% shareholding pattern we will see. We can apply this control model even where my holding is less than 50%, but yes, we need to see the other facts as well while applying this control model. So as we discussed about this, power right should be on the substantive rights, right? It should not be the protective rights. What are the substantive means? Substantive means that holder has a practical ability to exercise this right on a proactive basis. I will be in a position to apply my ability to exercise those rights. It should not be on the dummy basis. It should be on the practical basis. But there are certain barriers which should be there, which will stop you to apply this substantive rights. It could be your financial liability. It could be your legal barrier. It could be your operational barrier, right? So, and it could be your terms and conditions preventing holder from exercising the right. Suppose I am having a holding which we can say that more than 51%, 50%, but the rights are on the administrative basis. It's not on the substantive rights. I can't say that I'm having a control of your company. The right should be on the substantive right. It should not be a proactive rights, right? Might be that you are having a right, but under this particular law, like the insolvency code law, you can't apply the rights over your rights onto your company in which you have invested. So that means these are not the substantive rights. I can't say that I am having a control over your company, right? So this is called the substantive rights, right? So I am having the ability to exercise those rights on the practical basis, but it should not be proactive rights. So rights, what are the protections which have been given by legal or by contractual arrangement? So that should not be there, right? So it should be on the practical basis. So suppose how to apply this substantive versus the proactive rights. Let's take one example, very simple example, wherein we can understand that whether we are having a substantive right or not. So suppose an investor is a party to a forward contract to acquire the majority of the shares in the investee, right? The forward contract settlement date is 25 days. The existing shareholders are unable to change the existing policies over the relevant activities because a special meeting can't be held for at least 30 days, at which point the forward contract will have been settled. So means at my level, I can settle a forward contract in which I am dealing with, I can settle in 25 days. But if a company want to rectify or want to change my decisions, at least 30 days notice is required. So that means I'm in a position, because my settlement date is 25 days, I can say that I am having a substantive rights wherein I can prove that I can take my decision at my discretion level. So other shareholders can't change my decision. So in this case, we can say that I am having a substantive rights, right? So because 25 days settlement date has been required under this guidelines, so I can't change those decisions because the decisions changing requirement is 30 days, right? So in this case, I can say that I am having a substantive right in this company. So now let's look the other parameter of this control model, which is called the franchisor and franchisee part, right? So because the decision should be at the unilateral level, right? I am having a full discretion how to take a decisions in your company in which I have made a investments. So under this franchisor or franchisee model, we can say that because one would be the franchisor, another is the franchisee. So franchisor would pay some sort of royalty or some sort of percentage of sales to the franchisee company against the uses of the brand. So now the question would be, there's a control relationship would be there or not under the franchisor or franchisee, because the decisions or the control means that I am having a voting power. Voting power would not be there. Okay, we need to see the other facts. What are the other facts? Whether I am in a position to influence the relevant activities. So that is the thing that we need to see under the franchisor or franchisee model, wherein the control model would be there. Suppose in case of the Haldiram, you have by a franchisee, right? So against which you will pay some sort of commission to your owner or to the franchisee company. So now the question is, who is taking the decisions to fix the margins of your products, right? And for the credit settlement period and for the infrastructure based period, appointing the staff and the other managerial persons I am having or the other franchisee companies having, that we need to see, right? So, but in case of the franchisor and franchises, we can't say that the influencing position would be there or the power position would be there, wherein we can say that we will apply this control model or we will apply the consolidation accounting. But yes, in certain cases, if there is any relationship between the franchisor and franchisee, wherein we can say that one party is having an exclusive decision or exclusive rights to take a decisions over the another persons, we can say that we can apply this control model or we will apply this consolidation accounting under this 1110. Now come to the second thing. So firstly, we have discussed about this power. Power come from the rights. Rights could be your voting rights, or it could be the other contractual rights through which we can take a decision, or through which we can influence the relevant activities of the other company. Now the second thing is the exposure. Exposure or rights to variable returns from the involvement with the investee. It should be having any exposure, means you will get a returns in the form of the investment you have invested in your company. So it should not be on the fixed format, it should be on the variable perform format, on the performance basis. Like, so it could be the returns could be in the form of the positive way, or it could be in the form of the negative way, or in the both manner. But what type of the returns which has been defined in the standards, which we can say that yes, we are having a control over the another company. So returns are not fixed, it's basically depend upon the performance, right? So higher the performance, higher will be the returns. We can say that it could be positive, it could be negative, or it could be both. Like in case of dividends, interest, changes in the value of investments of the investee, servicing fees, performance fees, right? Or the returns which are not available to the other interest holders. It could be combination of the any two things, right? So these things are called, or these items are called that we are having a, uh, we are having a exposure over the uh, returns on the investment that we have made into the another company, right? So higher the magnitude of returns, we can say that higher will be the uh, relationship of the control model. Unless, suppose we are having a power and I am not getting any returns, so this control model will not be applicable, will not be applied, because all the three means power, exposure, and ability, right? So we should have the exposure as well. exposure to the Exposure right to the variable returns from its involvement with the investee. Now this is the third thing of this control part. We should have the ability to use its power. Unless and until I am having the ability to use its power, I am holding an investment, I am having an exposure or rights to the variable returns, but I am not having any ability to use its power. So that means I will not apply this control model, right? So the control model will get defeated. So I should have the ability to use its power over the investee over these returns, right? So ability should be there. So when we apply this ability to use its power, we can define that, or we can say that whether the principal, I am working as a principal, or I am working on behalf of the others, means I am working as an agent. So principal versus agent relationship we need to see if I am having the ability to use its power or not. Who is the principal? Who can take the decisions independently? Who is the agent? Who can't take decisions independently? The agent will take the decisions on behalf of the principal, right? So a decision maker means need to see four factors while applying this principal versus agent relationship or agent consideration, while using its ability to use its power. What are those four factors through which we can identify that I am working as a principal or I am working as an agent? So agent means that I am not having a power, I am working on behalf of the others. Principle means I am taking a decision independently, right? So these things we need to keep in mind. So what are those factors that we need to see while applying this agent versus principal relationship? So four things has been defined under this standard. One is the scope of the decision making authority over the investee. Another is the rights held by the other parties, the remuneration to which it is entitled in accordance with the remuneration agreement. The fourth is exposure to variable of returns from other interests that it holds in the investee. Now let's discuss these four items one by one. Scope of the decision making authority. So scope of a decision making authority means the decision maker is a full control. They can take their decisions independently. So this situation will apply in a situation where you have created a fund and you have appointed a manager or as an agent to overview your fund, right? So now the question is whether the fund manager is working as an agent or is working as a decision maker. Suppose I have created a fund and I am appointed a fund manager, and fund manager will get a returns which will depend upon the uh, investments of the returns, right? So as and when my investment returns would be there, I will get those returns. Means it depends upon the variability of the investments. So now the question is whether this fund manager will be working as an agent or will work as a principal part as far as the consolidation part is concerned, because this fund manager will invest in the fund as well. 20% equity, 50% or 30% equity they will invest into those funds as well. Apart from this, they will get some sort of returns in the form of performance fees. So four things we need to consider as we discuss. The first thing is scope of decision making authority. Who is having the decision making authority, whether it's a fund manager or some other entity. If it is a fund manager is having the decision making authority, so that means the fund manager is working as a principal, right? So it's working as a principal, not as an agent. The second thing is that the rights held by the other parties. If suppose there are the certain other parties who is having the investment in the fund and they have a right to remove the fund manager at any point of time. So that means I am not having a substantive rights into my fund. So other parties are having the substantive rights wherein they can remove at any point of time. So these things we need to see whether I am working as an agent or as a principal. So in the second case, rights held by other parties, if the rights held by other parties for removal on the removal part, so I can say that I'm working as an agent on behalf of the principal. Exposure, third thing is the exposure to variability of returns from the other interests. How much exposure I am having as having in for the investment that I have made into your fund, right? So higher the exposure of returns, higher will be the chances that I am working as a principal rather than as an agent. The fourth thing is the remuneration. Apart from the exposure part, the the fund manager or the agent or the other person, we can say that they will get some sort of remuneration. Remuneration could be your fixed part or it could be your performance based. If it is a performance based, higher will be the returns, higher will be the remuneration. So there's a chance that you are working as a principal, right? So there's no any fixed rule which has been defined. All the three factors, but the factors has been given. We need to judge upon whether this factor will be applicable for agent or working or as in principal. So we need to apply all the judgmental factors, right? So we are working as a principal or we are working as an agent part. So there's a new concept called de facto agent, right? What is a de facto? So de facto means that suppose you are having a 45% shareholding in your another company, and the another company is having, suppose B company is having 20% shareholding into the investee. I am having 45%. The another company, which is my sister concerns, we can say that, is having 20%. But this 20% company, the other company, can't take decisions at their own. Whatever decisions I will take, they will support me, right? Whatever decision I will take, they will support me. Means they are working on behalf of my decision authority. This is called the de facto agent. So that means it's not directly, it's indirectly. Other party can't take decisions, but they will support me in every type of decisions that I will make at the company level. It is called the de facto agent. So the determination of whether other parties are acting as a de facto agents require a judgment not only from the nature of the relationship, but how other parties are interacting with each other. Means the parties should be at the closer level. Close relationship should be there. Only and only in that case I can justify that, okay, this person is working on my behalf, and this is called the de facto agents, right? So five factors have been given to justify the relationship of the de facto agent. That means the other persons, we can say that is working as a de facto agent or working on behalf of myself or my company, right? This is called the de facto agent. So examples could be investors related parties, right? Through related parties, I can influence the other party. Okay, uh, just to take decisions, or we can say that the other can't take the decisions without my permissions. In the another way, we can say that, right? So relationship should be there. How the relationship can be justified might be that the other 20% shareholding company have taken a loan from my company. I have given the guarantee, financial guarantee to the another company. I have given the key KMP to the another company, right? So that means some relationship is being there. The another 20% holding company or my agent company can't take decisions independently. They have to give the acceptance of my decisions, right? So these are the factors we need to see whether the other company or other agent in which we can say that the de facto agents uh, are fulfilling this control model or not, right? So that's why this is a very important thing, just to apply the power position or the control model position. Now come to the investment entities consolidation. So as the objective and the scope part, uh, it was discussed that the investment entity will get excluded from the consolidation. So now the question is, what is the investment entity? First of all, we need to understand this investment entity. So investment entity, we need to follow the three criterias. Just to fulfill the definition part, we need to follow the three criterias. Obtain funds from investors for providing them with the investment management services, right? So I am into the investment management services. So that means I will be the investment entity company. Or my purpose would be, investment entity's purpose would be to earn capital appreciation. Means I am having an investment, I will sell it on the as and when the returns will be higher. Or investment income. Investment income could be through dividend or interest income or the rental income, or it could be the combination of the both. The third thing, which is the most important thing under the investment entity definition part, is that the performance and evaluation measurement of investments on fair value basis. Fair value basis means we need to measure those investments. Whatever the investment I have made in the another company, if suppose I'm having the investment entity, I am the investment entity and I'm having the investment into another entities. So that means I will measure all the investment at the fair value basis. My performance will be judged on the fair value basis. So I can say that I will be the investment entity. Means I am obtaining a funds from investors for providing investment management services. This is the first thing. Second thing, the purpose would be to earn capital appreciation or the investment income, or it could be the combination of the both as well. But purpose should be there, capital appreciation or rent, dividend, rental income. The third thing is that I will perform my evaluation on the fair value basis, right? So I will apply this, we can say that Ind AS 109, fair valuation through profit and loss. I will classify those investment into this fair valuation through profit and loss. So this is called the investment entity. So now the another thing is that what is the characteristics of the investment entity? In the investment entity, there should be more than one investment, right? More than one investment would be there. Not only single investment, more than one investment would be there. And more than one investors would be there, right? Investors are not related parties. And ownership in the form of equity or similar instruments, right? So so like in case of the private equity funds, they will invest in the another companies into their subsidiaries parts, right? So that could be an example of this investment, because the purpose is to earn the capital part or earn the capital appreciation part or earn the dividend part. So that's why this investment entity has been excluded from the consolidation point of view. So for this investment entity, neither 103 business combination nor this 1110 will get applied. If suppose investment entity is having the subsidiaries, they will not apply this consolidation accounting under 1110. They will get exempted, right? They will get exempted. Why? They will measure those investment under the fair valuation through profit and loss, FITPL, we can say that. So, but there is a one condition is that if suppose an investment entity is having a subsidiary who is not having any investment related activity, they are just providing some sort of admin services or some sort of other services, that will get consolidated, right? That will get consolidated, because normally what happens is that investment entity will make an investment to the another entity, and they will also in the nature of to earn the capital appreciation or rental or the dividend income part, right? So that's why this whole the consolidation accounting has been excluded from the investment entity, provided I will fulfill my investment entity definition part as well as the characteristics of this investment accounting investment entity part. How would I measure those investments in the subsidiary? Through profit and loss, fair value through profit and loss under this 109 financial instruments part, right? So now come to the main part. The definitions and the discussions part are over, because the discussions part which has been mentioned or which has been covered under this under the 1110 was not there under this IGAAP accounting part. So now after the discussion, suppose now it is clear that control model has been established. I will apply this consolidation of financial statements accounting. How this consolidation of the financial statements will look like, what type of the financial statements or what type of the items I need to prepare. Now let's discuss this one by one. One is the separate financial statements, and second thing is the consolidated financial statements. Consolidation financial statements means financial statements of the group. Group means it includes your subsidiary, it includes your the joint venture and the equity part. But how to do the equity and the joint venture, there's a separate standards which we will discuss it. So parent and the subsidiaries presented as a single accounting economic package, single economic package, right? So this will be the consolidated financial statement. So that we can say that we need to prepare the financial statements of the group. Group means parent with your subsidiaries. So now come to the second leg of this consolidated financial statements, which is the separate financial statements. Separate financial statements means I am having an investment in your subsidiary, in the another subsidiary. How would I measure this? Either at cost or as per this Ind AS 109. Its choice is company to company, right? Two things. One thing is, first thing is that you have made an investment into this subsidiary. The question is, how would you measure or how would you recognize those investment into the separate financial statements, right? Second thing is the consolidation of financial statement, which is the today's topic. Under this separate financial statements, you can do under this either at a cost as per Ind AS 27 or as per 109. Its choice on company, it's the company's choice basically. So when we talk about these components of this consolidated financial statements, so consolidation components of the consolidated financial statements would be a consolidated statement of financial position, which is the balance sheet, consolidated statement of profit and loss, consolidated and the other comprehensive income, consolidated statement of change in equity, then cash flows on the consolidation basis, and in the last it would be a notes. Whatever the components you will prepare under the separate financial statements or standalone financial statement, the same will be prepared under this consolidated financial statement, but it would be for the group as a whole under the one single economic package. So what are the features of this consolidated financial statements? It's a single economic entity, means parent with subsidiary part. It will be prepared on the combination basis. Uniform accounting policies. See, now you will, it is assuming that we are having a standalone financial statements. Standalone financial statement means a subsidiary with the parent. I am the parent and I'm having the subsidiaries. So firstly, on firstly basis, I will prepare the standalone financial statement, then my subsidiary will prepare this standalone financial statement, then I will prepare the consolidated financial statements. The second characteristics which we are discussing is that uniform accounting policies. What is the meaning of the uniform accounting policies? Uniform accounting policies means that whatever the accounting policies I will follow, I will means parent will follow, the same will be taken care by the subsidiary as well. So that is the uniform accounting policies. Elimination of intra-group balances, whatever the balances would be there, means receivable, payable, investment with the equity part, whatever the common items which we have traded with my subsidiary or with my parent, that will be eliminated. Elimination of intra-group transactions, sale, purchase, right? Whatever the transactions on the revenue and profit and loss side, that would get eliminated. Elimination of unrealized profits. If suppose a parent has sold a subsidiary has sold something to the parent, some item to the parent, and the same thing or same material has been lying in our books of account at the year end, and if suppose it's unrealized profit has been included, we need to eliminate those unrealized profit as well, because this consolidated financial statements for the group, I can't say that I will earn a profit with my own company, with my own entity at same year end means that if my financial year is 31st December or 31st March, the same should be there. But in some cases, in case of the foreign companies, foreign subsidiaries, might be that there will be some different financial reporting period. The standard says that, okay, in that case, the difference of the reporting period should not be more than 3 months, right? So in case the 31st December is your reporting, is the subsidiaries reporting, and 31st March is the Indian companies reporting. So that means, first of all, we need to have both the financials, means parent and the subsidiary. The reporting should be, or the financial statement availability should be on the 31st March itself. If it is not, we can use the 31st December by making the adjustments as well, by making this 31st December to the 31st March financials for the consolidation purpose. So what are those accounting requirements, right? So what are the accounting requirements which that we need to follow while making the consolidation of accounting part? So consolidation procedures would be a line by line item, means whatever the items which will be reflect in my balance sheet. My balance sheet means parent balance sheet, and whatever the items will be there in my subsidiaries balance sheet, I will do the consolidation line by line basis. Suppose my trade receivable, I will add trade receivable. I need to deduct if there is any common or if there is any intra-group transactions, right? Suppose subsidiary and parent has transacted during the year and some balances are lying. We need to deduct all these things, all common things. On the same basis, on the P&L side, I will do sales plus sales, purchase plus purchase. If there is any common transactions, common intra-group transactions, I need to eliminate all the things. Uniform accounting policies, as I mentioned, accounting policies need to be, all accounting policies should be on the uniform basis. So now come to the one practical scenario wherein suppose I am a parent and I am having a subsidiary. I am consolidating my financials with my subsidiary's financials. So now the question is, suppose I am using the depreciation under the WDV method, right? And my subsidiary is preparing the financials by taking the SLM method. Now the question is, how to do I? How to do I? We can say that uh, how this situation can be rectified, or the can be improved if there is any differences in the depreciation method. I am taking the WDV and my subsidiary is taking the SLM. Because the standard says that uniform accounting policies would be there. So can anyone from you let me know how can I rectify, or is there anything required in terms of the depreciation part?
Friends, you can reply in the comment section of your YouTube channel. So we are waiting for your reply.
Okay, so in the meantime, we can go ahead, or I can take that situation. So see, depreciation is a So in case of the depreciation part, suppose my depreciation method is WDV and another company is taking the SLM. So it's a estimate. Depreciation calculation is an estimate. It's not a change. It's not an accounting policy, right? So I don't need to bother about that, where that the my company is taking the WDV and the another company is taking the SLM. That is allowed because the standard says that you need to take the uniform accounting policies. Depreciation is not an accounting policy. It's an estimate. Now come to the second situation. Suppose in case of the property, plant and equipment, I am taking the revaluation model and the subsidiary is taking the cost model. So in that case, I need to make my subsidiaries accounting policy with the parents accounting policy, because the uniform accounting policy should be there. So in that case, we need to check all the accounting policies, whether the accounting policies are same or not, because the consolidation will get impacted. Otherwise, consolidation will get impacted, right? So these things we need to keep in mind while making the consolidation accounting. The third thing is the profit and loss allocation. So profit and loss allocation will be in between controlling and the non-controlling interest part, right? So non-controlling means who is having the controlling, and non-controlling in simple terms, we can say that the minority interest under the I gap. So non-controlling interest, whatever the percentage they are having, we need to allocate between owners and to the non-controlling interest part. It includes both the profit and loss as well as the other comprehensive income part. So non-controlling interest under the balance sheet part, it will be shown under the separate head, under the equity head, right? So the loss will be allocated if the NCI balance is negative, right? So that means if there is any loss, and the same need to be allocated between the NCI and to the owners, and if it's a negative, it will be still shown under the equity part as far as this Ind AS 1110 is concerned. So how the financial statements will look like, right? So I am assuming that we are having a knowledge of the separate financial statements, right? So we will have a parent financial statements. Then we will add all the numbers of the subsidiary, means net assets. If we can take an example, net assets on simple basis, we will add those numbers, right? If there's any consolidation adjustments, adjustment means if there's any intra-group transactions, we need to eliminate all these transactions. If there's any unrealized profits in the between transactions, we need to eliminate all these transactions, right? So the format would remain same. The standalone financials will get replaced by the consolidated financial statements. On the same part, on the profit and loss part, these standalone financial statements will get replaced by the consolidated financial statements, like revenue, profit or expenses part. We will do the consolidated adjustments. Consolidated adjustments could be your intra-group transactions plus or minus your unrealized profit part, right? So we need to add all these transactions, and we will deduct the intra-group transactions as well as the unrealized profit or loss part. And the same will get allocated, as I mentioned in the previous slide. The same will be allocated to the owners and to the NCI, means non-controlling interest part. So in this intra-group transactions, right? So intra-group transactions or intra-group balances, all thing will be need to be eliminated, as I have already discussed in the previous slides, right? So it could be your balance, it could be your profit and loss part, and if there is any unrealized profit and loss, the same need to be eliminated. Now come to the last part. Suppose you are losing your control, means you have made a sale of some percentage of equity into your subsidiary part, right? Suppose now you are earlier your holding was 52%, you have sold 10%, right? So now your stake is 42% or 43%, means control is lost. What we need to do? See, there's a one thing, only one thing about the measurement part of the investments, because till the time of the consolidation or till the time of the your investments fulfill the part of the consolidation accounting, you will apply the control model, or you will measure your investments under the cost or under 109. Most of the companies, I can say that they will apply this or they will measure their investments under the cost as per Ind AS 27. So now you are losing your control, or now your stake has been reduced to 42%, where you can't apply that the control model would be there. So that means we need to measure those investments, 42% investments, right? Earlier you are measuring your investment at cost. Now we can say that this 42% investment, I can say that whether I will apply this Ind AS 109 financial instruments, because investments would be there. The standard says that you can measure your investment as per 109, and whatever the difference is being there between the fair value or whatever the cost, that will be your gain or loss on the sale of your investment in the subsidiary. So we can understand this through one example, how you can measure your investments wherein you have lost your control. Suppose a parent sells 85% interest in the wholly owned subsidiary. The relevant details are as follow. So after the sale, the parent accounts for remaining 50% interest as an fair value through other comprehensive income under 0109 part, means fair value. So 85% I have sold and 15% I am retaining, right? So retaining investment would be covered under the financial instrument rule standard. The subsidiary did not recognize any amounts in other comprehensive income. Net assets of the subsidiary before disposals are 5,000. Cash proceeds from the sale, which is the 85% interest in my holding, is 7,500. Fair value of the 15%, the retaining interest is 1,300, right? So how would you recognize those entries? I will measure the 15% retaining part under this 109 part, Ind AS 109 part, and the fair valuation has been given in the question, which is 1,300, right? I have received a cash or bank while making a sale, which is around 7,500. My cost, I can say that under cost under the which has been given under the question is 5,000. So difference would be my gain or loss, right? So in this question, it is gain, which is around 3,800. The one thing we need to keep in mind is uh, just to uh, focus on the measurement of the investment that you will retain. That is a main thing that we need to keep in mind. Otherwise, whatever the debit or credit would be there, otherwise the gain you can apply, or you can calculate on the easy way, right? So that was an example of the loss of control part. So that was all about relating to the Ind AS 1110, wherein you will apply the control model. Now let's come to the second part of this consolidation, or the consolidation, which has been governed by the separate standard called joint arrangements. Ind AS 1111, we can say that. See, till now we are in a position to take a decision on the unilateral basis. What is the difference between these two things? Consolidation means control. Control means you are taking unilateral decisions at per your own level. Now we are going to discuss wherein you can't take a decision on unilateral basis, but on unanimous basis. Means two or more persons are there, wherein you can prove that, okay, I am having a joint control, not control. If control is there, 1110 would be there, right? But now control is not there, it is a joint control. This is the difference between this control and the joint control. So that's why there's a separate standard called joint arrangements under 111, Ind AS 111. So we will discuss about in this standard what is the meaning of the joint arrangement, what is the meaning of the joint control, what is joint operation, and what is the joint venture. Four things we will discuss it on primarily basis, right? So this standard is basically discuss about or the principles for the financial reporting by entities having an interest in the arrangements that are jointly controlled, right? So we will discuss about this joint control as well. What is the meaning of the joint control, right? So we will discuss in the later slides. So four things we will discuss. So this standard will be applied to a party who is into the joint arrangement, right? I have formed one joint arrangement and two parties would be there, A and B. So this standard will be applied to the parties, means A and B, who is having a joint control over the joint arrangements, right? So four things we will discuss. We will discuss the definition as well as the analysis part, right, in the later slides. So before starting, let's discuss through the definitions part, right? What is a joint arrangement basically? Because the topic is joint arrangements. So now the question is, what is the meaning of the joint arrangement, which has been given under the Ind AS 111? So an arrangement wherein two or more parties are having a joint control, right? Two or more parties. It could be two or it could be more than two. Joint control. Now the question is, what is a joint control? So the contractually agreed sharing. Word is contractually. So that means should be through contract. Agreed sharing of a control of an arrangement which exists only when decisions about the relevant activities as we discussed in the Ind AS 1110 part, the same will apply over here as well. Require the unanimous consent of the party sharing control, means you can't take decisions at your own level. Other parties acceptance is also required. That's why there is a joint control. If I have made an arrangement wherein both the parties is required for the acceptance purpose, so that means we can say that there is a joint control. Relevant activities could be the sale and purchase, capital budgeting, appointment of the KMPs, removal of the KMPs, merger and acquisition part, right? So acquisition of the subsidiaries, it could be anyone, right? So a party to a joint arrangement, who is a party to a joint arrangement? An entity that participates in the joint arrangement, regardless of whether the entity has a joint control of the arrangement. So means a party, we can, in simple terms, we can say that. So what is the meaning of the collective control? Same thing. We can say that all the parties are having or require the acceptance of the other parties. We can say that the collective control, right? So, but on the primarily basis, I can say that joint arrangement is the one thing, and joint control we need to keep in our mind while the discussion under this Ind AS 111. So now this joint arrangements, right? So this definition part, two or more parties. Two or more parties, how they can say that they are working under the joint arrangement? Through a contractual format, right? Parties are bound by the contractual format, contractual arrangements. So contractual arrangement, whether it should be in the written form or it can be in the verbal form. It could be anything, but written means you can prove into the court of law. So joint arrangements means parties are bound by contractual arrangement, and contractual arrangements gives two or more parties joint control over the arrangements. So a joint arrangement can be a joint operation or joint venture, because this the terminology joint operation and joint venture is very important under this 111, because this classification will determine the accounting part, right? So joint operation accounting is different, joint venture accounting is different. So while analyzing a contract into the joint arrangement format, we need to see whether my arrangement falls under the joint arrangement, joint venture or joint operation. So for the joint control part, right? Joint control part. So as we already discussed in the previous slide regarding the joint control, means you can't take decisions at your own level. Unanimous decisions requirement is there. So, but the thing is that contractual arrangement is there, right? So first thing is contractual arrangement. If the arrangement gives the parties joint control collectively, means all parties are having their same criteria of taking a decisions. If yes, we will cover it. If no, so that means it's out of preview from the 111. It can be part of Ind AS 110 consolidation financial statement. It might be that you are working under a control model, and you can apply the power and you can take decisions at a unilateral level, right? So that's why it is joint control versus control. The distinction is required. If I am working on a collectively basis, yes, I will be covered under 111, otherwise I will not. Now, the second thing is, do the decisions about the relevant activities require the unanimous consent? Means all parties acceptance is required. Yes, I will cover under the joint control, else I will be out of preview from the Ind AS 1111, right? So that's why the while analyzing the situation under this Ind AS 111, we need to understand what are the powers or what are the criteria which has been defined, what are the decision making power of the other entity. If I am working at my own level, that means I am having a full control. So that means this 111 is not apply. I will cover directly into the 110 consolidation financial statement parts. I can say that control model has been established and that become my subsidiary. So another company will become my subsidiary and I will apply the consolidation accounting, right? So this is called the joint control, and I have framed up in the tree format, decision making format. So now the question is, as we discussed in the previous slide, that joint arrangement could be joint operation and joint venture. Now, what is the meaning of joint operation and joint venture, right? A joint arrangement that whereby the parties have joint control of the arrangement, have right to the assets, obligation of the liabilities relating to the arrangement, that will become joint operation. And the joint venture is wherein the joint control of the arrangement have rights to the net assets of the arrangements. What is the difference? This difference will determine your accounting part, which accounting model we will follow for the joint operation and joint arrangement. Joint operation says that right to the assets. Rights means if there's any obligation, I will fulfill those obligation as well. If there are any losses, I will be obliged to pay those losses as well. That is called right to assets and obligation. What is the meaning of right to the net assets under the joint venture part? Net assets means that whatever I have invested in a particular format, my liability will be restricted to that one only. Net assets. I will not be liable for any further losses. If I have if I have formed one SPV, special purpose vehicle, for a for my joint venture part, joint arrangement part, it is it is into the corporate form, right? Corporate format means that my liability will be limited to the investment I have made. So that means I can say that I am having a rights to the net assets, means it's a part of joint venture. Wherein in the another scenario, wherein suppose I have made a format wherein I will be personally liable for the losses. So I can say that it will be part of joint operation rather than joint venture. So that is a definition which has been given under the standard. What is the meaning of joint operation and what is the meaning of joint venture? So how would you classify? Because this is a very important. How would you classify that particular transaction will fall under joint venture, or a particular transactions will fall under joint operation? If suppose a, a structure or an arrangement has not been routed through a special purpose vehicle, right? Special purpose vehicle, by default we can say that it will be fall under the joint operation. This is the first of the criteria which has been given under the standard, right? If it is not structured through a SPV, it will be part of joint operation. Now suppose you have created a SPV, special purpose vehicle, in the corporate format, wherein the rights and the limitations and the liabilities has been defined, right? Liabilities has been defined. It can be part of joint venture or it can be part of joint operation as well. Means I have formed one SPV wherein wherein the two parties has been there, A and B, Percentage of holding has been mentioned in the contractual format, in the contractual arrangement. 50% I have made investment, 50% investment made by the another entity, which is B. Apart from this, I can make another agreement to modify the SPV agreement that I will be responsible for the losses, or I will be responsible for the other liabilities that can be part of joint operation, even though SPV has been created. So that is the difference between SPV and non-SPV. If it is a non-SPV, by default, we can say that it's a joint operation. If it is created through the SPV, it can be part of joint venture, it can be part of joint operation, wherein I can modify those agreements, wherein I will write or I will mention that I will be personally liable, or there are a certain criteria has been given in the standard itself, wherein we can say that I will be personally liable. How I can be personally liable? Suppose in the S I am a company and I have created a SPV in the previous example of A and B 50-50%. If suppose this SPV is dependent on me itself, means they are selling all the goods to myself, right? So I have the obligation, if they are selling these things, if there's any losses or any further obligations, the standard says that still there is an obligation on the company's part, wherein it can be proved that this type of for SPV can be part of joint operation instead of joint venture. So this classification we need to keep in our mind while doing the accounting of Ind AS 111, right? So the same example I have already covered 50-51 per 50-50%, wherein you have created the SPV and you can still modify your arrangement and convert this joint venture to the joint operation. So what are the financial statement of the joint operator? So joint operator means who has invested into the joint arrangement. So this standard is applicable to the operator part only, joint operator part only. So means the accounting will be different for the joint operator and to the joint venture. Now let's discuss first about the joint operator part. So whatever the percentage you are having in your joint operation, you will take that one. Means 50% percentage of holding, we can say that is a simple thing, but it's not required that you will follow the percentage. If there is any other thing, other method, you can apply it. But generally, we are applying this percentage of holding method. Means I am having 50% share, but my arrangement falls under the joint operator operations or operator part. So I in the assets part I will include my share. In the revenue part I will include my revenue share. In the expenses part I will include it. In the liability part I will include all the percentage of the holding I will held. Right under the I gap. So this type of the method is allowed for the joint venture as well as to the joint operation, right? For the joint operation. But under the Ind AS, now this under the joint operation part, we will follow the percentage of holding method. Now come to the another thing. If suppose my arrangement falls under the joint venture, so under the joint venture, we will apply the equity method. Standard says that you will apply the standard which is given separately called Ind AS 28 investments in associates. So we will apply the equity method if my arrangement falls under the joint venture. So what is the equity method? So we will discuss in the Ind AS 28 slide part, in the later slide part. Right, so that was all about under this Ind AS 111. Now let's discuss about this investment in associates and joint ventures Ind AS 28. This is the third part of this consolidation accounting. So joint venture we have understood what is the meaning of the joint ventures. Now just keep in mind the joint venture part. This is the first thing in which we need to apply the associate accounting or the equity accounting. So Ind AS 28 says that if there is any significant influence under 110, we discuss for the control part, assuming that more than 50%. Under 111 under 111 standard, we discuss for the joint control part. Under Ind AS 28, we are going to discuss about the significant influence part. Significant influence means you are having an investment into the another company, means 20%, 20, more than 20%, but less than 50%, else it will cover under your 110, Ind AS 110. We are having an investment of 20, 22, 25% investment, wherein I can prove that, okay, I am having a significant influence. Significant influence means whatever the decisions whatever the decision will be taken care by the company, I am having the influencing power in your company while taking the decisions, provided that I am having some sort of holding, which is called 20%, right? So Ind AS 28 says that there is a presumption that the investor has significant influence over the entity where it holds directly or indirectly. Please focus on the word directly or indirectly through subsidiaries. Through subsidiaries means I am having a subsidiary 50%. I am company A. I am having a subsidiary company B wherein I am having suppose 55% holding. Now this B company is having an associate, means company C, wherein company B has invested 23% holding. Means A company, means parent company, is having directly or indirectly through subsidiaries, means this C subsidiary will be part of my consolidation accounting, consolidating financial statements, right? So it's the world is not through subsidiary, world is not through joint ventures, through subsidiaries. So as and when I am having more than 20% holding, wherein I can prove that I am having the significant influence through subsidiaries, directly or indirectly, my case will be fitted into the Ind AS 28. Now come to the second part, or on the reverse side. Might be that you are having an investment less than 20%, but still you can prove that I am having a significant influence in your company. You can apply this in Ind AS 28, but it's very difficult to prove that by holding less than 20% and you are having the significant influence, right? So while making this assessment of 20%, potential voting rights you need to see. Potential means convertible form, debentures, preference shares, rights held by the entity. How much conversion I will be received in the near future. You need to see while making the assessment of the significant influence. So significant influence, I can say that the same thing which has been given under this relevant equity part. It could be, it could be the participation in the policy making decisions, power to participation in the policy making decisions. Interchange of material personnel means I am providing technology to your company, right? I can prove that, okay, you are dependent on me. This is the one thing. You can analyze your situation wherein the significant influence relationship would be there or not. Material transactions between investor and the investee. Suppose you can't make a sale to the another company. You are heavily dependent on me. The same relevant activities that we have discussed, the same can apply over here as well, but depending upon situation to situation, right? So significant influence means the power to participate in the operating and financial policy decisions of the entity, but has no control. If control would be there, you will apply 110, as simple as that. But you are not having a control, you are having a significant influence. Influence could be part of your material transactions, it could be part of the transfer of your KMPs, representation on the board of directors, transfer of the technology, funding part. These things we need to keep in mind while analyzing these significant influence decisions. Now let's take one example how to analyze this situation in the practical scenario wherein you will apply this equity accounting under this Ind AS 28 or not. So suppose holding company and its subsidiary hold 9% and 23% respectively in the investee, right? 9 and 23%. I am having a separate investment. My subsidiary is having a separate investment. Holding company prepare the CFS, means consolidated financial statements, but subsidiary doesn't. Subsidiary account for this investment in associates in accordance with Ind AS 27 separate financial statements. So now holding will prepare the CFS. So definition says that directly or indirectly. My directly investment is 9%, but indirectly it is 23% held by the subsidiary in the associates. So now when I will apply this Ind AS 28 associate accounting, I will consolidate at 32%, means 9% plus 23%, because it's directly or indirectly, right? So it's 32%. Now come to the second scenario wherein holding company is having 9% and the subsidiary company is having investment in the another company, which is 15%, 9 and 15. So subsidiaries, from the subsidiary point of view, it's not even not an associate, but at the consolidated level, at the parent level, it's directly and indirectly. It is 9 plus 15, which is 24%, right? 24% investments. I will do the accounting under this equity method accounting. It will become my associates. 24% shareholding. It will become my associates. So I will apply this associate accounting under this Ind AS 28. So through this type of scenario, we can apply the uh, the uh, Ind AS 28 accounting. So what are the method or the procedures? That is a very important. How to do it? So under this is called the equity method of accounting under this Ind AS 28. There's a no full line by line consolidation, as we did in the consolidation part under the 1110 assets plus assets. It's not required under this Ind AS 28. It's not line by line item consolidation. So how would we do it? Standard says that whatever the profit and other comprehensive income will be earned by an associate, we need to take my percentage and apply on those profit and other comprehensive income part. On simple basis, I will take those profit or other comprehensive income in my financial statements. So that means it will impact on two things. First thing, it will impact on my investments. I will simply add or less if there's a loss. I will simply add or less the profit or loss, including my OCI part, other comprehensive income part. And the second impact will go to the separate line item of the income from the or share of income from the joint venture or the associate part, right? So standard says that whatever the profit the associate will earn, you will add. If there is any distribution of dividend by the associate, that will get deducted. That will get deducted. So, and the third thing, which is the adjustments. If there is any requirement that we need to take. Otherwise, adjustment means if there is any foreign exchange fluctuations, if you are having any investments in the foreign associate, and you need to translate those into the INR part, right? So if there is any adjustment, that we need to do it. Otherwise, it is not required. So on simple basis, uh, post acquisition share or profit part, including other comprehensive income part, we need to take and we need to add into our investments under this Ind AS 28 accounting part. So under this Ind AS 28, as we covered in Ind AS 110, uniform accounting policies should be there, right? Uniform accounting policies. Whereas in the Ind AS 28, it has been mentioned that uniform accounting policies should be there. If suppose there is any impractical way, or my associate is not following my uniform accounting policies, or the policy of the parent, right? The standard says that on impractical scenario, means if it is impracticable or impractical to translate the associate accounting into your parent accounting, that is allowed, right? That is allowed. Otherwise, the whatever the policy a parent will choose, the same will be applied by the associate as well. So now this associate accounting, Ind AS 28, or the equity accounting, profit and loss part will go to the profit and loss part, and the other comprehensive income will go to the other comprehensive income. Discontinuing of the equity method. If if you have reduced some sort of equity holding into your associate part, we need to discontinue the equity accounting, right? So what will be the remeasurement, or what will be the criteria for our retaining investments? Suppose my uh, earlier investment was 23%, now it has been reduced to 9%. So we can apply this Ind AS 109 financial instruments, right? So whatever the fair valuation would be there on the retaining part, and whatever the cost that you have recognized in your financial statements, so the difference would be profit and loss or gain on the sale of your investment. So as the same example as we covered in the Ind AS 1110 part. So exemptions to the equity accounting, right? So I will not discuss the all the equity accounting exemptions. Most of the same thing are applicable to are uh, same in the Ind AS 1110 part, except two exemptions. What are those exemptions? Specifically has been mentioned under this under the Ind AS 28 part. For the investment accounting, although the investment entity was not covered under the uh, Ind AS 110 part, right? Same thing has been mentioned under the Ind AS 28 equity accounting part. So when the investment in associate or joint venture is held by or is held indirectly through an entity, that is a venture capital organization, entity may elect to measure that investment at fair value through profit and loss in accordance with 109. What does that mean? So under the definition part, we covered that 20 more than 20% investment directly or indirectly. So now suppose the we are having an investment entity, right? Investment entity, and I am having a company under, we can say that I am a parent company. I am having further subsidiary, right, which is the investment entity, and this subsidiary, which is the investment entity, has invested into the associate part in the further associates. So under this 1110 rule, or under this 28 part, this investment entity can measure their investment under the FITPL rule, means fair valuation through other profit and loss part. So as a parent, when I will consolidate the subsidiary, the question would be, how would I do the consolidation of my associate part, wherein the subsidiary, which is the investment entity, is measuring those investments at the FITPL. It's a complicated thing, but the thing is, it is a very complicated thing, but the standard says that the parent company can retain those measurement bases as well. So that means the parent company can measure those associates under the FITPL rule as well, right? It's a complicated thing, but yes, we need to understand this logic as well. So now we can understand this concept through one example. So it will clarify you how to apply this investment account, this associate accounting under the if your entity are covered under the investment entity. So suppose entity P has a wholly owned subsidiary, entity X and entity X and entity Y, right? And this entity X and entity Y has further invested into an associates with having 25% and 20% shareholding. So wherein these subsidiary X is an investment entity, is a venture capital organization, and this investment entity has further invested into your associate part. So how would the associate accounting or the equity method will get applied considering this situation? So now the thing is, both the investments in the associates and entity X and entity Y, so we can say that it's fulfilling the significant influence, right? 25% and 20%. It's a significant influence part. So now the question is, how would the parent P would consolidate entity Z into their financial statements? And what would be the measurement criteria for this accounting of this associate Z? See, entity P must follow the equity method of accounting for the 20% part because it's not a venture capital organization, right? But under this equity, because the standard says that if it is held by the investment entity, it can get excluded, or you can take the same measurement basis as held by the investment entity. So in this example, two subsidiaries X and Y. So as far as the Y is concerned, Y is having a 20% interest in the associates. It's neither your investment entity, right? So we can say that whatever the investment held by entity Y to entity Z, I can apply the asset accounting, equity accounting under this Ind AS 28. Now look at the scenario wherein the investment is held through a venture capital organization or an investment entity. The standard says that whatever the method that will apply by the investment accounting, investment entity or a venture capital organization, a parent company can retain that method as well, means FITPL. So in this case, we can say that for the entity X, I can measure this investment under this FITPL part. And for this entity Y, I can measure those investments under this equity method, Ind AS 28, right? For the elimination, when we will do the accounting or the associate accounting under this Ind AS 28, we need to eliminate the if there is any unrealized profit, right? But we don't need to eliminate the balances as we covered under the 1110, because we are not applying this line by line model. We need to apply if there is an unrealized profit between the two entities, in associates and the another entity, we need to eliminate. That's it. We don't need to eliminate all the balances which are lying in associates and the other entities accounts. So there's another standard which we can say that the disclosure part. There's a separate standard has been given how to disclose the things under the consolidation part called Ind AS 112, right? So exclusive standard has been mentioned, has been given under this Ind AS part. So whatever the discussions that we had made about this 110, 1112, 1111 and Ind AS 28, all disclosures we need to give under this Ind AS 112 part, right? Or we can say that under Ind AS 112 part. So all disclosures, whatever the controlling part, whatever the non-controlling part, how much percentage you have held in your subsidiaries, how much percentage you have held in the associate part or into the joint arrangement part, whether your joint arrangement is your joint operator or a joint venture, right? So all the things we need to disclose under this Ind AS 112 part. So that was all about relating to the consolidation accounting parts.
Thank you much, Anil ji. Thank you very much. Session बहुत अच्छा रहा, sir. Now we move to next session on Q&A.
Okay.
We have some Q&A with us. Mr. Sumit Khurana. He want to know, sir, we have a transaction with subsidiary, exchange difference arising on contra transaction. While eliminating contra transaction will be credited to FCTRA or SPL?
See, sir, we need to see whether this is my non-integral transaction or integral transaction, right? If we are converting a foreign exchange differences of my subsidiary, that will always be part of my FCTRA, foreign currency translation reserve, and will be part of my other comprehensive income.
अनिल जी, आपने स्टार्टिंग में जब बताया था कि कंसोलिडेशन किस कंपनी में कैसे एप्लीकेबल है, उस समय एक क्वेश्चन आया था पायल गुप्ता जी का कि इज दिस कंसोलिडेशन एप्लीकेबल ऑन द प्राइवेट कंपनीज आल्सो?
Yes, on the private companies as well.
ओके, नेक्स्ट क्वेश्चन अगेन फ्रॉम सुमित खुराना जी.
देखिए प्राइवेट कंपनीज में क्यों एप्लीकेबल है, क्योंकि वो अगर मैं कंपनीज एक्ट की डेफिनेशन में जाता हूँ, इफ यू कवर द कंपनीज एक्ट डेफिनेशन, तो कंपनीज एक्ट सेज दैट इट्स अ मैंडेटरी, दैट्स व्हाई इट्स एप्लीकेबल टू ऑल. लेकिन हाँ, उस केस में एप्लीकेबल नहीं होगा इफ सपोज माय अल्टीमेट पेरेंट इज प्रिपेयरिंग द फाइनेंशियल्स एंड आई एम हैविंग ए फर्दर सब्सिडरीज. अगर मेरा एक ही पैक बनेगा, सो इन दैट केस इट इज नॉट रिक्वायर्ड टू prepare the financial statement by the subsidiary.
Okay. Next question from Sumit Khurana ji. All the three conditions required to be fulfilled in order to get exemption from CFS?
Sir, all the three conditions we require to fulfill under the control model.
Okay. अगर उनमें से कोई भी एक कंडीशन फुलफिल नहीं होती है तो उस केस में रिक्वायरमेंट नहीं है.
The requirement,
मतलब उस केस में हमें CFS मेंटेन करना पड़ेगा.
See, in the Indian scenario, as far as the Indian part is concerned, we are looking the percentage of holding. Means if I am having a 52-53% holding, then we will apply the consolidation accounting. There's a nothing discussion is required. No discussion is required. But where suppose I am having 48%, 47%, 49%, then we will need to see, okay, what are the other factors that we need to see while applying the control model. If I am influencing my decision making part, if other shareholders are with me or not, I am having the rights, but my rights are not substantive, just for the administrative purpose. ठीक है, किसी कोर्ट ने लगा दिया कि आप कुछ भी नहीं कर सकते इसमें. Okay. Although you are having a 51% shareholding or 50% shareholding, but you can't apply those rights. That means you will not apply the control accounting because you are not in a position to show your control into the another company. Okay.
So next question is from Binder Saini ji. Can company have control over other company with 0% investment in that company?
No.
Be parent of other company.
How can I apply a control wherein I am not having even a single penny in your company? I can apply it? No.
Having common directors, common KIP, not create the control there. Am I right?
Yes. You can show that, okay, I am having a common directors, but tell me, if there is any common directors, how can I prove it? If I am providing a KMP, key managerial personnel, or technology, something should be there. You can say that, okay, you are dependent on me, right? I am in a position to influence your sales margin, purchase margin, something like that. But the common directors doesn't mean that you are having a control over the another company.
And next question from Payal Gupta ji. Can one subsidiary be consolidated by more than one parent company based on equity holding more than 50% and other by having other veto right of control?
If the other is having a veto right, right? So that means I'm not in a position to say that I'm having a control. Suppose in your example, 51% or 52% holding, right? And still the other person is having a veto power to ratify my decisions. How can I say that I am having a control? So in that case, my question would get converted into the joint control. Means I can see that I can apply 111 Ind AS 111. So that's why the same thing I have mentioned in my slide, that if there is any veto power, right? So that case could be part of its joint control rather than the control part.
Okay. Good. And there is another question from Payal Gupta ji. If fund manager working as an agent, then consolidation done.
No, then no consolidation, because I'm working an agent. So other person having a substantive right to remove me at any point of time. But yes, in that case, suppose if the fund manager is investing, has invested some, suppose 25%, 30%, and they are getting a variable returns, and suppose the other investors can't remove him, in that case I can say that I'm working as a principal, then consolidation will get required.
Okay. The last question from Payal Gupta ji. If parent financial available on 31st March, but subsidy on 31st December, then I need to adjust for 3 months.
Yes, 3 months.
Okay.
So
Or
see,
it will be proportionately.
first of all, you need to ask the 31st March financials, right? If
Okay.
not, then what will, how would you do? Deduct the first three numbers, previous years, and then add the current year 3 years numbers, 3 months numbers. In that case, you can adjust your financials, keeping in view the Indian conditions.
Only in some case we have a consolidated financial. For example, we have a 12-month financial only. We don't have a 3-month financial separately. So in that case, can we use the pro rata basis?
Sir, in not a pro rata basis, suppose in your last example, right? Because this will happen only in case of the foreign subsidiaries, right?
Yes,
The
yes, yes.
foreign companies are having their financial reporting period Jan to 31st December. But your Indian scenario, it is 31st March, April to
March.
31st
Yes.
March. How would you do? So you will first April to December, means you need to deduct the 3 months number of the previous year, then you will add the 3 months number for the current year. In On that basis, you can prepare the financial statement of your subsidiary by taking the uniform financial reporting period.
You mean to say we have to go on actual only? We are not allowed to go on a pro rata basis,
See, sir,
basically.
this should be on the actual basis. If
Accuracy.
suppose there's an immaterial transaction, then you have to discuss with your auditors, because it depends upon the auditors, right?
Okay. Okay.
If it's a material transaction, that can't be allowed.
Anil, can you stop sharing your screen?
Yes.
So it is almost 2 hours session, Anilji. We are planning for 90-minute session, but
Okay.
still, although topic is very important and very lengthy topic, which require a deep study and analysis. So I express my sincere thanks to you, Anilji, for taking this session in a very best possible manner, and I acknowledge your special efforts, having health issues, even then you're taking the session with us. So thank you very much. And I also express my sincere thanks to all the participants, those who have joined us on Sunday morning, and also other participants, those who will join us at later through recorded session. So thank you very much, friends. Kindly also subscribe our channel so that you can get the information of upcoming sessions. Friends, we have also organized next 3 sessions for you. On 14th of July, we have session on the FEMA, basically how Indian company can invest outside India, and foreign company can invest in India. On that, Sudhaji will take session, and after that we have session on Friday on the Excel, all the important aspects of Excel, and between that on Wednesday we have session on GST also. So friends, kindly keep in touch with us so that you can get the information of our upcoming sessions. So thank you very much to all. Thank you, Nilji.
Thank you.